Hello, everyone, and thanks for joining us. It's been a year of Zoom and talking to my computer here, and I'm getting a little worried, actually, that it's all starting to feel pretty normal. But we're seeing green shoots and hoping for better days ahead. So welcome to another Private Markets Insider webinar. I'm Kevin McCaffrey with Private Markets Insider and Lacrosse Investments 37.4. I'm happy to be your host today, and I hope you're having a safe and happy spring so far. Today, we're talking about differentiated opportunities in private equity and venture capital. PE and VC investors face a first world problem. How do you outperform in these already top performing segments? On a 10-year horizon, private equity funds have posted the best IRRs of any private market strategy, with venture capital, real estate, and secondaries following closely behind. And on a shorter timeline, PE and VC remain at the top, but real estate and secondaries have struggled a bit. So PE and VC have already put investors in a good position. But how do you differentiate yourself further as an investor? Do you follow the best investors? LPs are sometimes described as sheep. Well, there's a reason sheep stay nestled in the herd. You don't want to get eaten by a wolf. Your job is to stay healthy, live a long life. Spring comes every year and sheep are shorn for their valuable wool. You can do this for a long time. And if you've been part of this growing herd, you've done it quite well. But even if you're part of a herd, some positions within the herd are better than others. There's a pecking order. No one wants to be the runt of the litter. Okay, you see I'm mixing metaphors here a bit, but you probably see where I'm going. It's about seeking incrementally better performance in a top performing segment through better selection. So how do you do that? Do you meet new managers? First-time funds and other emerging managers have gained a reputation for outperformance, returning capital more quickly. You might say they're hungry and eager to please, but it's nuanced. Institutional investors in our first panel may have some opinions to share. They might have had a different experience. So what else can we do? Do you do it all yourself with direct investing programs and co-investments? You might avoid fees if you can avoid the pitfalls. You'll hear some thoughts on that from family offices and others in our closing panel. Unfortunately, there's no playbook. Private markets investing requires a network of people with experience, people you trust, people that will tell you what they think. So we're having a conversation. We're building valuable community around valued investments. And with the Private Markets Insider platform, we're bringing you webinars, live summits, and investments that we can introduce to you directly. So let's get into it. First, a couple of program notes as we review the agenda. I'm going to share the screen here so that you can take a quick look. The following presentation is for informational purposes only. None of the information shared or the opinions given are to be construed as an offer to buy or sell a security. If you have any questions for the speakers during the program, please use the Q&A feature. We'll answer as many questions as we can during this webinar, and we'll follow up afterward to answer any questions remaining and to have conversations where appropriate. I'll take down this agenda here, but these and more details on the speakers are available on the website for Private Markets Insider. And now I'd like to introduce, so that's taking us now into shifting gears to dig into the VC arena. And in order to set up that conversation, we have one of our other webinar chairs here, Charles Sidman, here to create some context with a fireside chat with one of his colleagues and co-investors as they discuss early stage VC as a distinct asset class and why this matters. So Charles Sidman founded and directs ECS Capital Partners. He's a co-founder of the American Angel Capital Association and a past president of the Crowdfunding Professional Association. Charles is a frequent advocate and speaker on financial entrepreneurship, policy, and ethical issues globally, and an enthusiastic participant in numerous investment and professional organizations while supporting early stage companies through angel investing, venture capital, crowdfunding, and public markets. Dr. Sidman retired as professor of molecular genetics, biochemistry, and microbiology from the University of Cincinnati's College of Medicine. His education includes a PhD in immunology from Harvard, an MBA from University of Cincinnati, and sabbatical study on complex systems at Santa Fe Institute. So more than qualified to lead us in the latter half here as we jump into your discussion. And with that, Charles, please take it away.
Thank you very much, Kevin. It's a pleasure to be here with everybody today. We're going to first introduce Neil and myself, and then we'll go over a number of points, focusing on why the view that early stage venture is a distinct asset class by itself, different from later stage venture, and then describing the fund which I have put together to execute and capitalize on these insights. So Kevin introduced me a little bit, and maybe I can turn it over to Neil to introduce himself, and then I'll come back and give more introduction to me. So Neil.
Great, thanks Charlie. Nice to be here today with everyone. So my name is Neil Littman. I'm the founder and general partner at BioVerge. BioVerge is an impact investment platform and venture firm focused on democratizing access to early stage healthcare investment opportunities. We are focused on funding visionary entrepreneurs with the aim of transforming healthcare and bringing science fiction to life. Importantly for this discussion, our sweet spot is early stage venture asset class. We've built a portfolio of 24 companies over the last several years that span the intersection of health and technology. So I am excited to be here today and have a fireside chat with Charlie.
Neil, thank you so much. You're going to see during our fireside chat how Neil and I really resonate with each other. He is on my advisory board in my fund, and we are co-investors in a number of deals, and we share many of the end goals in our activity. So just to introduce myself a little bit more, my professional career has had 3 phases. The first phase is I was a computer guy. I designed and built hardware, and I programmed it to do some amazing things. We were doing in the early 1960s what is now broadly known as artificial intelligence, and we were capitalizing on what we call timeshare computing, but that became today's internet. Second phase of my career was in biomedical research, and three things were prominent during those years. First of all, I got my PhD in immunology, and I was involved with figuring out how the immune system actually works and how to apply it. Many of the companies that Neil and I invest in use these realizations and discoveries. Secondly, I was involved in the very earliest stages of genetic engineering and genome analysis, and we'll see, everybody knows how important those activities are. And thirdly, I've been involved in a new paradigm, a way of looking at the world called complex systems. It permeates everything we do here. And then the third phase of my professional life has been as an investor. I was at a sabbatical at the Santa Fe Institute. I met this really strange, fascinating guy. He told me he was an angel investor. I had no idea what that meant. I got into it. I was totally seduced and overcome. Got into it seriously myself, and that became my third phase of professional activity. So Neil and I are both involved in this early stage venture world now, and we work together quite a lot, and he's going to challenge me. I'm going to challenge him during this conversation. So the first thing we want to talk about, I want to just present the concept that we both feel that early stage venture or angel investing into young companies is a distinct asset class. It's different from later stage and what is more commonly known as venture capital. And we have a concept here that these companies have common characteristics which are more important than the particular financing mechanism by which we participate in them. So it's not about public markets and private markets. It's about young companies who have potential and probability and possibility and people, but what they don't usually have is a lot of hard historical data. They may not even have product market fit. They're often pre-revenue, And so that indistinctness or fuzziness requires unique approaches, but it leads to the first characteristic of this asset class, which is an amazing IRR. The earlier panel talked about low teen rates of return. The best data we have for early stage equity is that the average returns are 25 to 30%. And given the way that the curve is bounded at the bottom by 0 and can go as high as, to infinity, what that means is a lot of people don't do it well, but people who do it well have a higher return than the 25 to 30% average of the field. So it's real attractive. And that bakes in all the risk and uncertainty that we all know about. Secondly, it's a highly uncorrelated asset class. Everybody here knows about and values lack of correlation. The basic reality is that even in the worst of economic times, inventions are being made, discoveries, developments, value is being created. So even if the classical markets are taking a dive, the early stage is still producing value from nothing. And then lastly, the significance of this asset class. It's estimated, a lot of statistics show that the majority of new jobs, new standard of living, new tax revenues, et cetera, come from the young companies, the ones who are pushing the envelope, and those turn into the raw material for the later stage investors that we all work with. And why is this really important? The basic illustration would be, we deal with discovering and working with the Wright brothers when they are inventing aviation, or we deal with the development of companies using CRISPR, which allows almost infinite genetic modification. If you wait until later on, these things become part of the world. And yes, you can invest in Delta Airlines or a well-developed healthcare company, but we're getting in at the very earliest stages, thus giving the opportunity for a very high rate of return. So that introduces why we think early stage is a distinct asset class. This is different from late stage as real estate. Neil, anything to add on this first point?
Yeah, thanks, Charlie. If I could jump in and maybe just ask you a question or two. As you rightly point out, as we're investing in this asset class, we're not looking at historical financial data necessarily, not looking at EBITDA margins or growth rates, for example. A lot of companies don't have product market fit. So as you're assessing technologies and companies to invest in, right, there's a number of things you can look at. You can look at the team, the market, the technology. Do you overweight or underweight any of those compared to the others?
All right, well, that goes to the essence of what we do. For me, we always have a vision, and the entrepreneurs and founders have a vision. We have to buy into that as a possibility. We have to try to evaluate its probability. And for me, the two things that are probably highest importance after that are, first of all, the people involved. They lay out business plans, and that's the basis of our discussion. And we give and take and challenge. And it's during those discussions, we all know that the business plan isn't going to happen, but how they respond to the challenges and the uncertainties and the what ifs and what's your backup plan, that really tells us about the people involved. Secondly, the people that we're talking to have all drunk their own Kool-Aid. And so for me, it's very important to identify either a first customer or even a potential customer who's neutral and off to the side and is willing to say, if they can provide this, I'm buying it. It solves my problem. That's the neutral opinion that I really need. So how's that as answer to your question?
I think that's great. And I think that actually leads into the next topic I want to touch on, which is describing ECS and how it fits into the broader asset class. You talked a little bit about sort of the asset class in general. I think you have a pretty differentiated approach when it comes to investing in early stage venture capital. Can you talk a little bit about, you mentioned how you evaluate companies, talk a little bit about how you apply that to your investment strategy?
Okay, well, do you mind if I first give an overview of what ECS is all about, and then we'll get into how we do it actually?
Of course.
So what ECS is all about is I've been in analysis and research and discovery and understanding my whole life. And as I spent 20 some years in this early stage asset class, I've come to realize that there are problems, there are opportunities for vast improvement. So we have a landscape of investors, entrepreneurs, governments, other stakeholders, citizens, society, et cetera. And they tend to work all by themselves. They don't collaborate enough. So the silo problem. One silo is an enormous number of potential investors who don't invest. The whole system is deprived of their energy and activity and financing. That's a problem. We have the early stage investors who are often angels. They perform a unique, invaluable function of meeting the entrepreneurs for the first time and identifying them and coaching them and supporting them. But they often don't have either the expertise or very often the money to carry it home. Then you've got players with bigger pocketbooks, funds, high net worth individuals, family offices, et cetera. They have all the money that they can use, but they don't have the visibility and access into the early stages. So they don't know which companies to back. And then, so all of these parties, players are doing their own thing kind of by themselves. And that's the problem that ECS is designed to help solve or improve on, is to integrate and synergize all these different players using the access and the financial resources and the expertise in the different silos together to make the whole thing work better for everybody. Now, that's the intent, and it applies to early stage equity as a whole. Additional choices of ECS are, one, we focus on sophisticated science and technology-based enterprises, so-called deep tech. And we do that because, one, intellectual property is patentable, protectable, and it allows outsized growth and thus outsized financial return. Secondly, my background in sophisticated science and technology is where I naturally fit in. And thirdly, or as another choice we make, ECS focuses on impact investments, investments that, besides aiming for outsized financial return, also make a positive impact on the world. And it's my thesis, actually, that the impact is not just a convenient or comforting add-on, it's actually an essential, because solving a sustainable, long-standing, real problem leads to a better, sustainable, real business opportunity. So those are the two types of, or gates through which ECS operates: the deep tech and the impact.
And Charlie, could I just follow up with a question on the impact side of the equation? So, I often run into folks who, are interested in impact investing, but are concerned that you might sacrifice returns by going after impact investments. Could you talk a little bit about how you think about that?
Sure. To me, that's a false dichotomy. As I was just trying to say, impact helps identify the best business opportunities. In the old days, when we called impact CSR, companies that had that lens did better, purely financially, purely business-wise, than companies that didn't. So my IRR target is to be above the average, and I do that. I think I can attain that largely through, for me, impacting and technology investing. There are other ways to do it. I don't want to say this is the only answer. Consumer goods and video games and sports and entertainment. There's all sorts of ways to make a lot of money. But this is a way that I think is possible for me to contribute to, and for my investors to benefit from. Related to that is, it's the IRR that really matters to me. And there's a lot of talk about unicorns and home runs as very infrequent but very rewarding events. That's not the only way to attain this IRR, in my opinion. An investor or an investment group that gets 1 out of 10 investments to be a unicorn to pay off the whole activity, that is one approach. Then they have to live with 8 or 9 failures out of those 10. But another approach is to have only 2 or 3 failures, 8 or 9 base hits, gazelles, with some occasional unicorns. That's another way, and I think probably a more reliable and reproducible way of attaining that very high IRR target. So I don't see impact as an alternative or a sacrifice. I see that as one of the component ways to achieve this goal.
And so, Charlie, I think that's a nice segue. You mentioned a little bit about your strategy, your differentiation at ECS. I'd like to dive into that a little more, just in terms of what differentiates you, how you source deal flow is critical in the early stage venture business. So we'd love to understand a little bit about how you go about sourcing your deal flow.
All right. Well, this is one of what I consider our sources of differentiated advantage. I'm going to be a little bit immodest here, but I think I have an unparalleled diversity and thus ability to select among deals. And I'm going to illustrate this with some sample investments in the closing segment here. But I work with the United States funds over 5,000 early stage deals a year. They're considered angel deals. I have visibility into a good number of those, and I have visibility into a good number of those that are outside the US. So the diversity of opportunities through many different channels is one of my strong points. Secondly, that gives me a diversified team that I work with each time. So my style is to co-invest always with other investors, which means we can share the diligence. They do some, I add more based on my own science and technology and personal evaluations. So I think the diligence we do is improved. And actually, it's been suggested that my scientific background is actually one of my main secret sauces. Another thing I'll point to is that we focus on a portfolio in this early stage asset class. We don't just publicize deal by deal and invite people to participate. We guarantee a diversified multi-stage portfolio for every one of our investors. And that means we divide their committed funds into 4 buckets. The first bucket, quarter, goes into several hundred early stage companies at a small investment level. Out of those several hundred, we then commit the second quarter of their funds to maybe a fifth or one-tenth of the initial companies with a larger investment, a follow-on when it's warranted. The third quarter bucket is further follow-ons yet. So every one of our investors is going to have a multi-stage representation of very early deals, and then deals that are getting more of their resources and are proving themselves, and finally deals that are just scaling off the charts, and they would get to participate in all of those. My goal is to deliver each of our investors that portfolio. Now, having said that, our larger investors can also super invest or put additional funds in deal by deal in the later stage, larger deals. And so that gives them the opportunity to be active investors as well as passive beneficiaries.
And Charlie, I always find it helpful with examples. Are there maybe a couple of examples from your portfolio that you could share with the audience today? Because I know you cover sort of a wide range in terms of your deep tech investments. So a couple of examples are always helpful.
Right. So that's a good way for us to close this fireside chat. In the last 20 years, I've made more than 100 investments in this early stage arena, more than 40 in the last decade. And over that time period, health written large is my biggest single sector, slightly more than half my investments. Sustainability and energy have been another quarter of my investments, then a scattering of other things. So I'm going to tell you about a couple of investments, both in the health arena and a couple in the sustainability arena, very briefly. What you're going to see is that my investing style tends to go for concrete and technology-based investments over virtual or consumer brand. Other ways, for other folks to make money, it's not what I do. I want something concrete and technology-based. So I'm going to give you several examples. The first one is a company called AssureX. It was based on the genetics that I know so well. It was the ability to determine for an individual patient, personalized medicine, which medications they should take, the ones that would benefit them, the ones that might harm them. And that grew into a semi-unicorn. It was an M&A acquisition. I made 6 to 7 times my money on that one. Yeah, I was very happy with that. A second one, a very recent one, is called PMI Diagnostics. It's a Swedish company. It also came from the angel world, but this time from the European Business Angel organization. It was presented at an event in Ireland. I invested in this Swedish company with colleagues from the south of France, and this company is solving the tuberculosis problem first targeted to India. TB is actually bigger than COVID and more long-lasting than COVID as a global health risk. And these guys can crack that problem. A third one I'll mention, BedCura, I got from a crowdfunding platform. I then went into personal due diligence. I invested against all my usual norms via a safe note in the beginning. It's now in regular priced rounds. It's absolutely flourishing, blowing the top off the chart in bleeding control. It's in military and civilian use and manufacturing now. A fourth one, Alveo Technologies, I'll mention because it came through a Wall Street investment banker channel. It's recently won the X Prize from over 700 applicants for the best COVID detection, point of care, cheap, fast, rapid detection for COVID and other, noxious viruses. And so now it's going to probably have an IPO within the year. The last two I'll mention, one is X-Row Technologies. I met it at a Canadian small cap conference. It happened to be a public company already, even though it was the same valuation and totally pre-revenue when I got in. It's done fabulously well. It's close to being a unicorn already. I built up a position gradually. I've returned my original contribution, but that's given me a 30x return, and it has a long way to go. And finally, I'll mention Nextion Technologies. I met this at a closed door space technology meeting. I was there as a speaker, a participant, high security, but I was behind the barrier. And I met the company, the people in this company. These people are revolutionizing global aerospace navigation and guidance. Pretty soon, every flight any of us take will be guided by these people's technology. So huge opportunity. It's also impact because it's going to save probably a quarter of the cost of maintaining and fueling and polluting in the whole aviation industry. So the takeaway, these are 6 different deal sourcing channels. Most organizations use 1 or 2 of these, and they're not the only 6 that I have. So it's a distinct opportunity, conceptualization of the asset class, a distinct way of utilizing it, and it's full service. Someone can be either totally passive or active with us, and I don't think anyone else offers this range and set of resources today.